Welcome to IFRS 2 again. So today we'll solve one more question. First you come to one question number 20. You'll find after a few pages. Question number 20. 20 or 21, just check. 21. The following particular in respect of stock option granted by a company are available. Grant date 1st April 2006. Number of employees covered 525. Number of options granted per employee 100. Vesting condition is continuous employment for 3 years. This is called service condition. Nominal value of equity share is 100 rupees per share. Exercise price is 125 rupees. Market price per share on the grant date is 149. Vesting date 31st March 2009 and exercise date is 31st March 2010. Now they have given you fair value of the option per share on the grant date. So we are going to take fair value of the option if it is given. If not given, then we will take the intrinsic value, which is the difference between market price and exercise price. But if fair value is given, you take the fair value. Fair value of option is calculated using option valuation models like Black-Scholes model, binomial model. But in this subject, this value will be given to you. So you don't have to worry about it. And then you have to also understand that we have to estimate the number of options that are likely to vest. And for that we have to estimate how many employees will be completing the 3-year service condition. So now what they have done, they have given position on 31st March 2007, estimated annual rate of departure 2%. What is estimated annual rate of departure 2%? 2% employees would leave every year. Every year in the future 2% employees would leave. Number of employees left is 15. Now understand this, then you will understand the remaining. How many employees we had in the beginning? We had 525 here in the beginning. Number of employees 525. Then this is beginning. This is end of year 1. 15 left. So now we have 510. But we have to estimate how many employees would be there till the end of year 3. How many employees will be there till the end of year 3? That we have to estimate. So what they are saying, there is an estimated annual rate of departure of 2%. Which means what you will do, 510 minus 2% will give you the estimated number of employees in year 2. Again minus 2% will give you estimated number of employees at the end of year 3. So how much is that estimated number of employees? Something like 490 point something. 489.80. So you can say 490 approximately, no problem. So in my first year, I expected that 490 employees would fulfill the 3 year of service condition. But when I go to second year, next year, what happened? 10 more employees left. So whatever actual data is available, we'll take actual data. So we had 525 employees here. 15 left in the previous year, 510, 10 more left in this year. So we have 500 employees in year 2. And what is my estimated annual rate of departure here? 3%. Means I expect next year 3% employees would leave. So my revised number of employees who are expected to satisfy service condition is 485. Then I come to next year. Now I have actual data. 15 left, 10 left, 8 left. So how many employees were finally eligible here? 492. Now these people are eligible to purchase the share of the company by paying the exercise price, which is 125. Number of employees who are actually exercising their option is 480. So how many employees did not exercise? 12 minus 480, 12. In the exam, this line is not given. You have to calculate 492 minus 480. Compute expenses to recognize in each year and then pass the journal entries. Okay. So first you write down step 1. Step 1. Calculation of expense to be recognized. Calculation of expense to be recognized. Once this table is ready, then passing journal entry will become easier. This is similar to the problem that we had solved with some more details. So dear student, write on the right hand side 3 columns: 2006-7, 7-8, 8-9, 3 years. Draw lines using scale. First point number A, write point number A, number of years, or you can write vesting period. In this problem, vesting period is 3 years, 3 years, 3 years, because it is service condition. So right from the beginning we know the options will vest after the employee gives service for 3 years. Then point number B, write down fair value of the option per share. Fair value of the option per share, which is given in question, 30 rupees, 30 rupees, 30 rupees. If fair value of the option is given, take fair value. If not, then take intrinsic value. Okay. Point number C. Number of share expected to vest under the scheme. Number of shares expected to vest, VEST, under the scheme. Now keep question in front of you. I will explain again. 525 employees had signed this contract. On the screen, 15 employees left in the first year. So we have 510 employees at the end of year 1. Expected annual rate of departure is 2%. So each year 2% employees would leave the organization. This is estimated into 98%, means 2% left. Again into 98%, means 2% left. Students have asked this question, why 2 times we are multiplying by 98%? Because 2 more years are remaining. And then into 100 options per employee. So multiply, write down the number will come to 48980. 48980. Then second year you do like this. You can prepare a working note below. 525 into 100. If you do into 100, this is the exact number. So don't worry. It is only an estimation. Estimation can change. You can calculate on the basis of 490 also. It will become 49,000, 20 rupees difference. Don't worry. Be happy. Materiality. 525 minus 15 minus 10. Okay. Now we have got the idea that 25 have already left. So I just need to estimate for next year. Next year 3% employees would leave. So into 97% into 100. So that comes to 48,500. And then in the third year, they have themselves given you the number 492. So take 492 into 100. 49,200. This is final figure. Point number D, write total expense. Total expense Total expense will be B into C. Fair value of the option per share is representing the value of service. What does it represent? Value of service. Okay. Fair value of the option represent value of the service per share. Into this multiply 14 lakh 69,400. Dear student, again 30 into 48,500. 40,55,000. 30 into 49,200. We will write 14,76,000. Then point number E, cumulative expense to be recognized. Cumulative expense means up to year 1. You will recognize 1/3 because this expense is for rendering 3 years of service. Is it right? So 1/3. Tell me 1/3. 4,89,800. 2/3 of this number. 2 years out of 3 years are over. So cumulative expense to be recognized 9,70,000. And then last column full. Don't calculate. Some student is calculating that also. 14,76,000. Now point F, write down expense recognized up to last year. First column 0. Second 489,800. Third 9,70,000. And point number G, write down expense to be recognized in the current year. Expense to be recognized in the current year. First column same 489,800. Then take the difference E minus F 4,80,200 and the last column 5,06,000. Okay. Now pass journal entries for 3 years. But before that, we will do some more analysis. If I ask you, what is the value of the options forfeited? Because if the option is not exercised, then it will not be transferred to P&L account. It will be transferred to other component of equity. Total equity figure will not change. Either you issue in the form of share, and if it remains forfeited, it's not used, then we will transfer it to another reserve account. Okay. So calculate that. How many employees are eligible? 492. Write down. Number of employees not exercising, 492 minus 480, 12. Then number of options per employee, 100. Number of shares not subscribed, 1,200. What is the fair value of option per share? 30. So the total value of option forfeited that will be transferred from one equity account to another equity account is 36,000. After the vesting period is over, the total value of equity is not changed. Then either you use it for issuing share or you transfer it to other equity account. After this, I am going to ask you one more question today. Since you are an intelligent student, how much amount will you transfer to securities premium account per share? In this question number 21. Show your intelligence to this world. Because when you have to pass journal entry, you have to transfer the premium to premium account, capital to capital account. Anybody? Your exercise price is 125 rupees. That is the amount paid in cash. Plus add fair value of service. Fair value of service received is nothing but fair value of the option, which is 30 rupees. So employee is paying you 125 in cash and he's rendering services whose value is 30 rupees. So total consideration received per share is 155. Total consideration is 155 and the face value, write down 100 rupees. Face value is 100 rupees. So therefore the securities premium per share would be 55 rupees. So this 55 rupees per share we will require when you will pass journal entry for issue of shares. So what we'll do, we'll now write down journal entries. Draw the format, one full page. Total number of years involved in this problem are 4. 3 year is vesting period and then 1 year is exercise period. Time given to employees to purchase the share, 1 year. After writing this, now listen to me carefully and write journal entry. Keep working note 1 in front of you. In working note 1, we had this entry 489 800. What entry will you write? Raji, employee benefit expense account debit, yesterday you written to share based payment reserve account. Employee benefit expense account debit 489800 to share based payment reserve account to share based payment reserve account 489800. One more entry. Are you writing the date 31st March 2007? One more entry. P&L account debit. Same date. P&L account debit to employee benefit expense 489 800. Done. Second year. Date 31st March 2008. 31st March 2008. Employee benefit expense account debit 4,80,200 to share based payment reserve account 4,80,200. Done. One more entry on the same date. P&L account debit 4,80,200 to employee benefit expense account 480,200. Good question. Whether this share based payment reserve entry, it will go directly. Because one effect you are giving in P&L account. Now write down third entry 31st March 2009. 31st March 2009 is same entry, employee benefit expense account debit 5,06,000 to share based payment reserve account 5,06,000 to share based payment reserve account 5,06,000. Then P&L account debit 5,06,000 to employee benefit expense account 5,06,000. Done. Now how many employees have exercised their option? 480. And each of them is given how many options? 100 options. So dear student, how many shares will be issued? 48,000 share will be issued. What is the face value? 100 rupees. So your entry will be share based payment reserve. Share based payment reserve debit, account debit to share capital 480 employees into 100 rupees. Wait, one more entry I have to write. Bank account debit, correct? Okay, bank account debit will be 480 employees into 100, 48,000 share. And what is the exercise price? 125. Calculate 60 lakh. To share capital will be 480 employees into 100 shares into 100 rupees face value. Is it 48 lakh? And to securities premium, 480 into 100 into 55. This we had calculated. How much? Okay. So how much we will write in share-based payment reserve? 480 into 100 into 30 rupees. How much? 480 into 100 into 30. 14 lakh? 14 lakh 40,000. There are two ways we can cross check. Total should match. Yes. Or you can simply calculate 480 into 100 into 30. 30 rupees the fair value per share. So this is the entry for issue of share. And one last entry. What is the date you have written for this? 31st March 2010. The date of exercise. Share-based payment reserve account. How much amount is remaining in this account? Already calculated. Working note 3. To general reserve. How much? 36,000. 36,000. Is it telling? Balance in share-based payment reserve transferred to general reserve. Now next discussion. Cash settled share-based payment. What do you mean by cash settled share-based payment? These are those share-based payment plans where the counterparty, who can be an employee also, will be paid cash. How much cash? It is linked to the value of the share. If it is only cash payment, then there is no share-based payment reserve. The amount of cash to be paid is linked to the market value of the share. And therefore, they are called cash settled share-based payment plan. So here what is the principle will follow? Measure the goods or service acquired and the liability incurred at the fair value of the liability. Now here my obligation is to pay cash. So cash based payment, cash settled transaction will be treated as liability, not equity. And since it is liability, we have to measure the fair value of liability first when we enter into transaction, and second on every reporting date till the settlement is done. Okay. So in cash based payment, we have to take the fair value of the liability and it has to be remeasured on every reporting date till it is settled. That we don't do in case of equity settled because value of equity is not changed every time, but value of liability will be changed every time. The entity will remeasure the fair value at each reporting date and up to the date of settlement. And if there is any change in the fair value, recognize it in the profit and loss account. There could be vesting condition attached to such share-based payment. Like equity settled, even cash settled share-based payment plan may have vesting conditions to be fulfilled. Like example, 3 years of service. So in this case, my task will be every reporting date, calculate the fair value on reporting date, and change in fair value on reporting date will be recognized in profit and loss account. This exercise you will do till the liability is settled. Till the liability is settled. There is one example number 8. Can you see that? An entity issues share appreciation right. What are these plans known as technically? Share appreciation right. Cash settled transactions are called share appreciation right because the cash paid is linked to appreciation in the value of the share. Entity issued share appreciation right to existing employees who remain in service for next 3 years. And the benefit will then be settled in cash of an equivalent amount of share price. So the amount of cash is linked to market value of the share. So this is called cash settled share based payment. Now if there is no vesting period or no condition is required to be fulfilled, means he has already done his service, given his service, so no more vesting period, no more condition. Since he has already rendered the service, what we will do, the cash settled share based payment will be recognized fully at the time of initial recognition only. The reason is simple for you to understand. He has already rendered the service. So there is no need to now amortize it in future period. But if he has to render some year of service, then it is amortized over the period of service, because then we are matching the service rendered, okay, with this expense. Example printed below, point number 2, 8.2. Management of an entity decides to issue bonus amount to certain key employees for their past service based on the share price of the entity. The amount equivalent to the share will be recognized immediately as cost of employees because there are no conditions which are to be vested upon. So while solving the questions, one has to really check whether any vesting condition is to be fulfilled or not. If not, calculate the amount, recognize it immediately. Now we will solve one important question number 12. This is based on share appreciation right. XYZ issued 10,000 SAR that vest immediately to its employees on 1st April 20x0. The SAR will be settled in cash. Now when will this stock appreciation right vest? Let us read further. At the date it is estimated using an option pricing model that the fair value of the stock appreciation right is 95. SAR can be exercised any time up to 31st March 20x3. It will vest on 1/4/2010, but you can exercise it up to 31st March 2003. That means your accounting will go on till 31st March 2003. At the end of the period, on 31st March 2001, it is expected that 95% of total employees will exercise the option. 92% of total employees will exercise the option. This was expected at the end of year 2. And finally, 89% will be vested only at the end of third year. So the meaning of this paragraph is that first we expected 95% people will exercise. Then my expectation changed to 92%. And then my expectation changed to 89%. So I have to keep changing my estimated liability figure. It will change because of two reasons. One, because of the change in the number of employees, and second, because of the change in the fair value of stock appreciation right. The fair value at the end of each period is given to you 112, 109, 114, which means finally you have to pay at the rate of 114. Okay, pass, journal, entries. But first what you do, first you do the calculation of expense to be recognized in each year. Now the problem says XYZ issued 10,000 share appreciation right that vest immediately to its employees on 1st April 2010. So it has vested in year 2010, 1st April, but they will exercise over 3-year period. Heading, write down step 1. Expense to be recognized. Right hand side 4 columns. Year 0, year 1, year 2, year 3, or you want to write exact date. First April 2000. No, this is enough. I know. That is why I prepared like this. Point number A, fair value per unit. When you gave this stock appreciation, right, fair value was 95. So initial measurement at 95, subsequent measurement as the fair value would change. In equity settled, it does not change fair value. But for liability, the fair values are revised. So now number of SAR, 10,000, 10,000, 10,000, 10,000. Expected to vest, expected to vest, VEST, 100%, 95%, 92%, 89%. So now we will calculate cumulative expense to be recognized. Cumulative expense to be recognized will be product of the first three numbers. Fair value per unit into 10,000 into expected percentage. Is it 9,50,000? 10,64,000? 10,02,800? 10,14,600? Point E, write down expense recognized up to previous period. Expense recognized up to previous period. First column write 0, first column always 0. Then you shift this 9,50,000 to next column. 10,64,000 in the next column, 10,02,800 in the next column. So now write down the last line of this table, current year expense. Current year's expense. First column D minus E, 9,50,000, 1,14,000. Then there is a negative figure also, 61,200. You will reverse the entry. And 11,800. Right. First, today we'll pass entry for this amount, 9,50,000. And then every reporting date, we will increase or decrease the liability. And a second effect will go to P&L account. And then finally, how much amount we end up paying? We'll end up paying 10,14,600. This is the amount we will end up paying. Okay. So dear student, write journal entries. Journal entries, write down date, particulars, debit, credit. First entry will be today only, 1st April 20x0. Entry will be this time employee benefit expense account debit 9,50,000, but credit will not be given to share based payment reserve. Credit will be given to share based payment liability account. Share based payment liability account 9,50,000. Being fair value of SAR recognized. Okay, next. 31st March 20x1. 31st March 20x1. Employee benefit expense account debit 1,14,000. to share-based payment liability account 1,14,000 being fair value of SAR remeasured. Okay. Now to save time, I am not transferring this employee benefit expense to P&L account. Otherwise, you write in bracket P&L account, P&L account. Or you can just take the total and pass one more entry for transferring the expense to P&L account, right? That you can do. Now come to 31st March 20x2. This year there is a reduction in the liability. So reverse the previous entry. Share-based payment liability account debit 61,200 to employee benefit expense account 61,200. To employee benefit expense account 61,200. Narration is important because you are passing a reverse entry. Being fair value of SAR remeasured. Being fair value of SAR remeasured and reversed. Fair value of SAR remeasured and reversed. Then you go to the last year. How much is the extra liability in the last year? 11,800. Employee benefit expense account debit 11,800 to share-based payment liability account 11,800. To share-based payment liability account 11,800. And then you have to pay. If you look at the liability account balance, it has a balance of 10,14,600. So that will be settled now by paying cash. Means entry will be share-based payment liability account debit to bank account 10,14,600. Okay, done. Now we'll talk something about intrinsic value. Come to previous page. There is a diagram there. Above that diagram, there are 2 points. All these questions that we solved till now were based on fair value. Okay. So I will revise first in case if you have acquired goods or services from others. First priority will be fair value of goods and service received. If that is not available, fair value of shares to be issued. Okay. Second, if you are dealing with employees, then we'll take fair value of shares to be issued. That means fair value will be based on shares to be issued, not on the basis of service rendered by the employee. Because the standard assumes that fair value of service rendered by the employee cannot be calculated reliably. But now the point is, what if the fair value is not available of equity instrument also? Then the entity will initially recognize at intrinsic value, at the date of receipt of goods. If it is goods or service, intrinsic value. Then the student is asking, what is intrinsic value? So somewhere you write down intrinsic value is equal to market price minus exercise price. Market price minus exercise price is called intrinsic value. And in case of intrinsic value, there is one more thing you have to do. Because intrinsic value is based on the current market price of the share. Suppose current market price of the share is 150, exercise price is 100, it is 50. But by the time the share will be vested, the market price will change. So right now the company is thinking that my cost of service is 50 rupees. The value of the service rendered by employees 50 rupees. But if suppose the market price changes to 160 rupees, then the value of the service becomes 60 rupees. So it will keep changing. What was the actual value you received will be known only on the vesting date. Yes or no? Say yes. Therefore, if it is based on intrinsic value, not on fair value, because fair value takes into account the probable prices in future also, because it is based on option valuation models like Black and Scholes, which takes into account the volatility in the share price, time, interest rate, etc. But here I am directly taking the current price of the share. So the standard is saying that as the share price is changing, the value of the service that the employee is rendering is also changing. So therefore, if you are using intrinsic value on each subsequent period and on each reporting date up to the date of final settlement, changes in intrinsic value will be recognized in statement of profit and loss. Okay. So it would be like cash settled only, but the credit will not be given to if it is equity settled, credit will be given to equity account only. And if it is cash settled, the credit will be given to, of course, the liability account again. Okay. But the intrinsic value will have to be calculated every time. So what is a small summary of this discussion? See this small chart. Is it there in your book? Measurement of employee settled transaction. Measurement of equity settled transaction with employees and not with employees. If it is with employees, on the left side, can fair value of the instrument granted be reliably measured? The answer is yes. Extreme left side. So measure at fair value. The answer is no. Measure at intrinsic value. Remeasure at each reporting date and settlement date. And any change in intrinsic value will be recognized in income statement. Come to right side. With employees, not with employees, means suppliers of goods and service. Measure at fair value at grant date of goods and service. And there is a comment on the right side, at the date entity obtains the goods or the counterparty renders the service. Take fair value of the date when entity receives the goods or the counterparty renders the service. Then the question is, this is the date. Then the question is fair value. First you check, can fair value of goods and services be reliably measured? If the answer is yes, come to this side. Measure at fair value. If the answer is no, follow this arrow. You come to this now. Can the fair value of equity instrument be measured? If the answer is yes, equity. If the answer is no, intrinsic value. And if it is intrinsic value, remeasure at each reporting date and transfer the change in intrinsic value to income statement. Is this diagram understandable? Same thing which was printed above in 6 points is presented in this diagram. Now one more complication. Share-based payment plan with cash alternative. Share-based payment plan with cash alternative means either you choose cash or you choose share. Sometimes this choice is with the entity. Either we can give you cash or we can give you equity. So these are called share-based payment plan with cash alternative. Accounting depends on who has the choice. Accounting will depend on who has the choice. Employee, that means the counterparty, or the entity. So for SBP transaction in which terms of arrangement provide either the entity or the counterparty with the choice of whether the entity settle the transaction in cash or other assets or by issuing equity instrument. The entity shall account for the transaction or the component of that transaction as a cash settled share-based transaction if and to that extent the entity has incurred a liability to settle in cash or other assets. So this is like a combination of both cash settle also, equity settle also. So we will see the accounting. account it like a cash settle if the entity has incurred an obligation to settle in cash or other asset, and account it like equity settle based share payment transaction if and to the extent no such liability has been incurred. So again, one has to read the terms and condition of such agreement carefully to decide the accounting, whether the obligation is to settle in cash, will it be settled in cash, or will it be settled in equity, and then who has the choice. Now I have written in detail paragraph by paragraph. First, assume the counterparty has a choice of settlement. Counterparty can be employee or supplier of goods or service. So do we know what he will ask? Do we know what he will ask? No. So then it becomes a compound instrument, because he can ask for cash also. He can ask for equity also. So what I will do, I will treat it as a compound instrument. From the total value of the instrument, we will first find out the value of liability component, and equity will be the residual. When such alternatives are being given in case of transactions other than employees, again here two discussion, but both are same. If the transaction with parties other than employees means we have received goods or service, value the goods or service at fair value. That we can do. Value the goods or service received at fair value. Then the fair value of the debt component will be deducted from the fair value of such goods or service, and then you will arrive at the fair value of the equity component. And once you are able to identify liability component and equity component, liability part will be accounted like cash settled share based payment transaction, and equity portion will be accounted like equity settled share based payment transaction. The liability part is remeasured on every reporting date till settlement. Equity is not remeasured, right? So see the small diagram I have drawn. Calculate the fair value of goods or service received minus the fair value of the debt component, that is the cash payment that will occur, or you can say liability, and the balancing figure will be equity component. Example number 9.1 or point 2. Example 9.2. An entity buys some equipment from a supplier, and the entity provides an option to take either cash or equity instrument equivalent to the value of the share price of the entity. Okay, buy a machine, give him two choice. What do you want, cash or share? But for accounting purpose, this becomes a compound instrument. So we will first find out the fair value of goods received. Let us say equipment, fair value. Then we'll find out the fair value of the cash settlement. How much cash we'll have to pay, fair value of that. And if there is a difference, then the difference between the fair value of the goods received and fair value of the cash settlement option will be treated as fair value of the equity component. This will be remeasured, cash settlement. Equity will not be remeasured. In other cases means employees only, because first was other than employees. A separate fair value of equity and debt component will be calculated, and accordingly the value of goods or services received will be accounted. So first we'll take the total fair value of the plan, assuming equity settlement. Then deduct the cash settlement, assuming employees will opt for cash. First assume all of them will opt for equity, so that becomes the total fair value of that plan. Then you check how many people or what will be the value if everybody opts for cash. This is everybody opts for share minus everybody opts for cash. So this is called cash settlement or liability component. The difference is called equity component. With some example, this entire thing will become easier. Now the question is, how about the accounting? The other party has the choice. So how many accounts I will have to open in this problem? 3 accounts: employee benefit expense account, share based payment reserve account, share based payment liability account. Employee benefit expense, we are closing it every year, but 2 accounts are open: liability account, share based payment reserve account. At the date of settlement, liability will be remeasured again at fair value. And now there are 2 possibilities: employee or the counterparty opts for equity instrument, opts for equity instrument, it does not opt for cash. So what will happen to that balance lying in that liability account? Treat it as a consideration paid for the share issued. Treat it as a consideration paid for the share issued. So the balance lying in liability account, you will transfer to equity. Treat it like as if it is a consideration paid for the shares to be issued. So liability account debit to equity account. Which account has closed? Liability account has closed. And then from the equity account, you issue the equity shares. So what I have done, I have written the journal entry also. If you want to write, you can write. In case of cash, in case of counterparty having the option to either opt for share or opt for cash, and if he wants to opt for shares, what about the accounting entries? Is it right? So write down, first write down in the notebook, share based payment plan with cash alternative. Share based payment plan with cash alternative. Under that write down choice of settlement is with counterparty. Choice of settlement is with counterparty. Then under that write down annual entries. Annual entries means suppose it's a 3-year problem, then these 2 entries you repeat for 3 years first. Okay. Every year you'll write this entry: employee benefit expense account debit, employee benefit expense account debit to share based payment liability account for liability component, to share based payment reserve account for equity component. And then second entry you write every year: P&L account debit to employee compensation expense account. P&L account debit to employee compensation expense account. This is entry will pass every year. Only in the year of settlement, the entry will be different because it depends on what is your choice. Now you write down below on the date of settlement. On the date of settlement, case 1. Case 1, counterparty opts for shares. Counterparty opts for shares. Under that write first you pass the entry share based payment liability account debit to share based payment reserve equity account. First you have to do the fair valuation of liability. Now, up to that date you have to value it like a liability only. And then it goes to
It will become part of reserve. In case 3 years are involved and in second year I am doing fair valuation. And due to that my liability is
no
increased.
problem. So whatever is the value of liability on the date of settlement, this is what the employee is supposed to receive. He says, don't give me this money, give me shares. So this amount is actually what I was supposed to pay him, which he says, don't pay me, you keep it with you. So you treat it as a consideration for the shares that you are issuing to me. So of course it will take into account the change in the fair value of the liability. So what is your query? Because that's a consideration you are receiving. Right now, of course, this is the consideration, this is his money. Share based payment liability is what you are supposed to pay to him. I didn't get your question. What would have happened if you would have computed on? But that you don't know, na? That is a compound instrument. But that you don't know. This is a compound instrument. In compound instrument, first you have to compute the liability part. What will happen after 3 years or 4 years, we don't know. So this you are assuming had we computed like equity. So this amount is the amount payable to employee. Suppose you paid this amount to him. He uses that money to purchase the share. This is what you will get. Okay. So instead of two transactions, you pay him cash and he wants to buy the share. The same amount we are using for issue of equity share. Had we issued equity share, this you will know only after the 3-year period is over. Till that time, it is a compound instrument. Same thing we have learnt in financial liability also. So this is right. Because this is the consideration he is paying to us. The opportunity cost is this amount he can ask for cash and he can use that money to purchase the shares. To share-based payment reserve equity account, and then this equity account you use it for payment of share, issue of shares. So equity share payment reserve equity account, share-based payment reserve equity account, to share capital, to securities premium. Okay. Case 2, write down below that. Case 2, the employee or the entity pays in cash. First you see the note printed in the book. This is given. In case 2, the other party wants cash. This is simple. You pay the liability and keep the equity with you. You can transfer the equity from one account to other account. This is printed. If entity pays in cash on settlement, that payment shall be applied to settle the liability in full. Liability account closed. Equity component previously recognized shall remain within the equity. But what companies will do, they will transfer it to some reserve account like general reserve. The interpretation of this entry is that if the other party opts for cash settlement, he is forfeiting his right to receive the equity instrument. Journal entry on settlement right. First year, second year, third year entry will be same. Case 2, employee opts for cash. If he opts for cash, I have already calculated what would be the amount payable to him. Share-based payment liability account debit to bank account. Share-based payment liability account debit to bank account. And second, share-based payment reserve equity account debit to reserve account. Balance transferred to reserve. But it will not go through P&L account, but it will be only transferred from one equity account to another equity account. Now we'll solve one small example. Question number 13. On 1st January 20x1, ABC Limited gives option to its key management employees to take either cash equivalent to 1000 shares or 1500 shares. Choice is with you. Cash, it will be based on 1000 share, or you can take 1500 shares. The minimum service requirement is 2 years, and the shares being taken up must be kept for 3 years. So there is a restriction on transfer of shares. So if there is a restriction on transfer of the share, the fair value of the share gets affected, because one of the important ingredient for calculating fair value is the liquidity also. So this share does not have now liquidity, so its fair value will get affected. Now you read the details given. Fair value of the shares are as follows. Share alternative fair value with restriction 102. Grant date fair value on 1st January 113. Then fair value on 31st December 2000 X1 120. Fair value on 31st December 2000 X2 is 132. The key management exercises is cash option. What they decided? Cash. Take cash, relax. Pass journal entries. But what we'll have to do, if the option is with the other party, it is a compound instrument. And in a compound instrument, we have to find out the value of liability part, and then it will be accounted like a liability, and the equity will be accounted like equity. Equity is not remeasured, liability will be remeasured. So this last two numbers which they have given to you is for liability remeasurement. So can you tell me what is the value of equity component in this problem? Equity component you have to ascertain today. If the employee opts for shares, he will get 1500 share, and the value with restriction we will take, because in case of share there are restriction. So fair value of the share will be based on 102 rupees with restriction. Multiply. This is the total value of the plan. 1500 into 102. And then only cash settlement fair value is 100,000 into 102. Is the difference positive? If the difference is positive, then we will get the equity component. So write down the answer. Step 1, first find the fair value of equity component. Find out the fair value of equity component. Write in notebook neatly. You have to read it also one day. Particulars rupees, fair value under equity settlement. Fair value under equity settlement. 1500 into 102. Check the calculation. Is it 1,53,000? Then you write down fair value under cash settlement. Fair value under cash settlement. Then you take 1000 share and take the share price without restriction 113. So today the fair value of your liability is 1,13,000. And the whole instrument fair value is 1,53,000. So the difference portion indicates there is equity component in this. 40,000. This 40,000 will not be remeasured. It will be amortized over the service period, which is 2 years in this problem. So each year how much you will transfer? 20,000 to expense and 20,000 to equity. But this liability component requires remeasurement. Okay. So tell me, dear student, how much expense will you recognize for liability component in the first year? How much expense you will recognize for liability component in the first year? Any answer? 1 lakh? 20,000? No. It is a 2-year problem, not 1-year problem. Okay, first you write this note. Step 2, expense to be recognized for equity component each year. For equity component, just find the value initially and then divide by number of years. Vesting period 2 years. So equity expense to be recognized for equity component each year is equal to 40,000 divided by 2. 40,000 divided by 2. That is 20,000. Now write down step 3, expense to be recognized for cash option. Expense to be recognized for cash option. Under this, what I'll do, go to year 1. What is the fair value at the end of year 1? 120. Number of options under cash option scheme 1000. So 1000 into 120. But the number of years are 2. So you'll have to take 60,000. Okay, one more chance. What will be the expense to be recognized in the second year? Second year. 72,000. First you calculate cumulative value. 1000 into 132 minus previous figure 60,000. I have already recognized 60,000 in the last year. So my cumulative expense should be 1,32,000, 60,000 already recognized. So you're right, the answer is 72,000. Okay. Now you are ready to pass the journal entries. Write down journal entries. Debit, credit, 2 columns on the right side. First 2 years we are going to pass entries like this. Employee benefit expense account debit. First write down date 31/12/20x1. Employee benefit expense account debit 80,000. Why 80,000 in the first year? 60,000 for liability and 20,000 for equity. To share based payment liability account 60,000. To share based payment reserve equity account, reserve in bracket equity 20,000. Okay. Then go to next year 31/12/20x2. What you do, you write here P&L account. This will be transferred to P&L account, employee benefit expense. Employee benefit expense account debit 92,000 now. Why 92,000? Because liability is 72,000 and equity is 20,000. Okay. After this, you have to pay the liability because the question says key management exercises his cash option. So the fair value of his liability is 1,32,000. Share based payment liability account debit 1,32,000 to bank account 1,32,000. Options settled in cash. And what about that 40,000 rupees which is lying in your share based payment reserve equity account? Transfer to general reserve. To share based payment reserve equity account debit 40,000. Equity in bracket to reserve account 40,000. To reserve account 40,000. In this question, they have mentioned clearly that the employee would go for cash option. Okay, we'll practice one more. This is question number 16. Check. Question number 16. Ready? Tata Industries has incurred a share-based option to one of its key management personnel, which can be exercised either in cash or equity, and it has the following features. There are two options printed below. If you go for option 1, you'll get cash settled shares. 74,000 number, service condition is 3 year. Option 2, if you go for equity settled shares, you'll get 90,000 share, condition 3 year. In equity settled share, restriction to sell is for 2 years. Fair values. Equity price with a restriction of sale for 2 years is 115. So 115 multiplied by 90,000 will give you fair value of equity settlement. And fair value granted 135 into 74,000 will give you fair value of cash settlement. If the difference is positive, then we'll call it equity component. And then like previous question, next 3 year, this time it is a 3 year problem. You are given fair values, pass the journal entries. Is it clear whether the employee wants cash or share? So what we'll do? Both or assumption? Assumption, not both. We will see. At least first compute the fair value of equity component. Fair value of equity component. Haji, what is your answer? 3 lakh? 3,60,000. It is a compound instrument. In case of compound instrument, you have to separate the liability and equity on initial recognition. So fair value under equity settlement, take 90,000 into equity price with restriction of sale for 2 years. That is 115. So it comes to 1 crore 3,50,000. And suppose they opt for cash, the fair value under cash settlement, write neatly, fair value under cash settlement 74,000 into 135. In the amount column 99,90,000. 99,90,000, that is called liability component. So the difference is called equity component. It has some feature of equity. Because if everybody goes for 99,90,000, then the entity will benefit 3,60,000. So that is equity component. Now my question is, how much equity component expense will be recognized in each year? Divide by 3. So write down step 2. Step 2 will be expense to be recognized for equity component each year. Expense to be recognized for equity component each year. Take the equity component figure 3,60,000 upon 3 is equal to 1,20,000. Now write down step 3. Expense to be recognized for cash option. Expense to be recognized for cash option. First year you tell me. First year is easy. What is the fair value at the end of that year? 138 into 74,000 divided by 3. 34 lakh 4,000. So this is also a presentation you can follow for fast calculation. Then year 2, what you do, take 74,000 into 140 into 2 by 3. This will give you cumulative into 2 by 3, right? And then previous year figure take from previous working. This portion will give you cumulative expense. Cumulative for 2 year. This is previous year already calculated. So how much is the answer for year 2? Anybody? 35,02,667. Wonderful. Year 3 calculate and give me the answer. Let me see who will give me the answer fast. Year 3. Come on, year 3. Haji, year 3. You are not answering. Deduct the previous 2 figures. Some student is deducting only one figure. Is the answer 3971,333? Okay. If you can present like this, you can do it, but this is very difficult for others to understand. Tabular format is easy to understand, it takes more time. Make a choice. Have you understood this calculation? Go ahead. Write down journal entries. Those 3 numbers I will require in journal entries. First, you write down the date 31/12/20x0, employee benefit expense account debit 35,24,000 to share based payment liability account 34,04,000 to share based payment reserve account 1,20,000. This employee benefit expense in bracket write P&L account. We are not passing one more entry. Understand, it will be transferred to P&L account. Then one line blank 31st December 20x1 employee benefit expense account debit. Credit side, first write down the 2 figures. To share based payment liability account 35,02,667 to share based payment reserve account. To share based payment reserve account 1,20,000. So what is the total? 36,22,667. And then you write down in the third year 31/12/20x2 employee benefit expense account debit 40,91,333 to share based payment liability account. How much was the third year figure? 39,71,333 to share based payment reserve equity account 1,20,000. Okay. Up to this the entries will be same. Then the entries will change depending upon what assumption you want to write. So now write down assumption 1, cash alternative. Assumption 1, cash alternative. What is the balance in that share based liability account? Do you have any figure ready? 1,08,78,000. If I add the 3 figures you have credited to liability account and then you make the payment to bank account 1,08,78,000. Being options settled in cash. And then there is one account which will remain open that we will transfer to reserve account. You can just write reserve. Share based payment reserve equity account debit 3,60,000 to reserve account 3,60,000 to reserve account 3,60,000. Answer is not over. Alternative 2. What is alternative 2? He wants equity shares. So the balance lying in his liability account is the consideration received from him. Will be treated as consideration received from him. Share based payment liability account debit 1,08,78,000. Share based payment reserve account debit 3,60,000. We are combining the two entries. Share based payment reserve account debit 3,60,000 to share capital account 90,000 share into, oh, face value is not given, assume 100, 90 lakh. If you want to assume 10 rupees, write 10. Accordingly, write an assumption below. And to securities premium 22,38,000. Close the answer, write an assumption. Face value of the share is assumed to be rupees 100. Face value of the share is assumed to be rupees 100. Okay, now we will take a break.